Right. Good afternoon. Welcome, everyone. We have a few people trickling in here, but we'll get started. I am Nick Ryland, co-founder and certified financial planner here at Vantage Point Financial. Excited to co-present today with Tim Kuntz, my co-founder and also a certified financial planner. This is our quarter one 2027, or sorry, 2026 quarterly market update. We have a lot to cover, and we're excited to spend this time with you. But first, a couple housekeeping items. This is recorded or will be recorded. And after the webinar, you will receive a link. So if you want to rewatch this or you want to share it with friends or family, feel free to do that. Also, we are where we will take questions, but use the Q&A button. You should see that on your screen somewhere. Many of you are probably used to a chat button. This webinar has a Q&A section, so put your questions in there. We will address those at the end. We'll leave plenty of time for all of your questions. Also, all of this data is through first quarter, so March 31st, 2026, unless otherwise noted, and we will touch on what's happened the last 3 weeks as well, into the start of quarter two. So let's jump into our agenda. All right, we're going to cover a recap of the market performance, stocks, bonds, commodities, you name it, from the first quarter. We'll jump into kind of the headlines of all the geopolitics and oil, the Iran conflict. We'll look at the inflation, jobs, Fed policy. We'll talk about just kind of dive a little bit deeper into which sectors performed well and which didn't the first quarter. And then, as always, we'll zoom out at a long-term perspective and how we approach planning that can help your portfolio.
Thanks, Nick. So let's start with some of the headlines and put them into proper context. If over the last 3 months or so, all you paid attention to were the headlines, it probably felt pretty negative. I want to be really clear that while Q1 was negative, this truly was a modest pullback, not necessarily a market crisis. And we're going to show you a lot more data today to explain just how normal this first quarter was. One of the most important points here is that the S&P was actually down the exact same amount in Q1 of 2025, down about 4.3%. Last year, it was tariff concerns. This year, it's Middle East geopolitics. Different cause, but really the same market result. And in both cases, that kind of pullback was well within the range of normal market behavior. Bonds were basically flat, which means they did what they're supposed to do. This is kind of a nod towards diversification and managing volatility. But even after a difficult quarter, the S&P is still up strongly if you look back over the last 12 months. This positive 18% is simply looking back 12 months from the quarter end of first quarter 2026. For retirees especially, this is a really important reminder that one quarter does not define your financial plan. So there's a lot of data on this slide, and I really want to paint a picture of why this is a story about diversification. If all you owned in the first quarter of this year was U.S. growth, big tech, some of those momentum stocks that we see in the headlines, Q1 of this year probably felt a lot worse than it actually was if you were a diversified investor. Because on the flip side, if you were diversified, other areas really helped absorb some of that pressure. For a lot of the client meetings that we've had during Q1, the way we've described what happened in Q1 was a bit of a rotation. Selling some of those things that make headlines and buying some of those things that are sitting on the bench, maybe undervalued or waiting to get some of their limelight. So if you draw your attention, like under United States markets, to the first couple of categories, we see small value and large value. These are value type companies in the United States. And what we saw in Q1 was when people were selling those big outperformers, like technology and infotech and all those types of sectors, we saw people buying small and large value. Therefore, if you owned all of these categories rather than simply, technology or growth in an outsized manner, you really just didn't feel the full weight of that downturn in Q1. So again, we saw value outperform growth, and this held true in international markets as well. And if we look at international as an aggregate, we saw that if you owned international stocks in Q1, this also helped soften some of the volatility because international stocks and emerging markets tended to hold their value a bit more firmly than in the United States. This is very different than 2023 and 2024. We saw a handful of mega cap growth stocks driving much of the market, but so far we have investors, both retail and institutional, casting a lot of lines here. Um, Leadership in these areas changes, and that's normal. That's why it's important to not build retirement plans around what has been the hottest investment lately, but rather, diversification. And diversification doesn't mean that every single piece wins every single quarter. It just means that we don't want your plan dependent on just one of these areas winning above and beyond the others. So drilling down a little bit further, the last slide we talked a little bit about large cap or small cap, value versus growth. Here we're talking about sector performance. So this is a breakdown of first quarter this year of the 11 sectors in the S&P 500. 6 out of these sectors were positive, and if you can see the difference between the top performer, energy, and the bottom performers, there's about a 50% discrepancy between the two. Energy was the big winner this quarter. That's no surprise. A lot of that is led by oil and some of the volatility that we've seen there. But utilities and consumer staples did really well. This tells you that investors were leaning a lot more towards steady defensive businesses. That's a deviation, not a deviation, but a different way to explain the concept we just talked about, the difference between growth and value. Some of those utilities and consumer staples are more classified as value companies. So while people were selling maybe the momentum ones, they were buying those. The lesson here is very simple. Sector leadership is always going to rotate, and it rotates very unpredictably. If we try to guess that next winning sector ahead of the time, you're usually going to lose. It's a really difficult guessing game. But a diversified portfolio doesn't need to predict which sectors are going to work. It just needs to be prepared for the different turns that might be ahead of us. So if same as we just talked about, if your portfolio participated in some of these areas that were a bit propped up inside of the S&P and elsewhere, it's just a sign that diversification did its job and softened the blow of the negative downturn in the market.
So we want to touch on market performance since the start of April 1st. And I'd love for each of you to put either yes or no in the Q&A section here. Who is aware that we hit all-time highs on the S&P 500 and the NASDAQ by the end of last week? So barely 2 weeks into the new quarter, after a volatile first quarter, was anyone aware that we hit new highs? If you were aware, type in yes. If you were not, type in no. I'm just really curious. So we got one yes so far. Thanks, Greg. I know you pay attention. Um, so yeah, a lot of yeses so far.
Yeah, a few, lots of
That
yeses.
that's great. I think a lot of people, a couple knows. A lot of people aren't aware that the market just came flying out of the end of the first quarter. We had 12 straight positive days on the S&P 500, 13 straight positive days on the NASDAQ, which is an all-time record. And we had a little pullback starting yesterday, but actually this morning the NASDAQ opened up higher and set an even higher new high today. So it's kind of shocking when there's a lot of volatility. We still have things going on in Iran that we'll get into here in a minute. The issues didn't go away, and all of a sudden we're up 9% in those first 17 days of April in the S&P 500. So pretty impressive. It just goes to staying diversified, staying invested. You never know when the market will rebound. You can't predict it because usually it happens when you least expect it. That being said, the dominant story in the first quarter was really geopolitics and oil. So February 28th, the U.S. and Israel um, had a coordinated strike on the Iranian nuclear facilities. There's been massive disruption to the Strait of Hormuz, which 20% of the global oil supply flows through. And so oil has gone up. It's been extremely volatile. We hit a high in Brent crude of $118 a barrel on March 31st, and it started the year at $61, so almost a doubling. WTI crude typically tracks a little bit lower price. And just for information's sake, Brent crude is the price of oil internationally, and WTI crude is the price of oil that comes from the US. It stands for West Texas Intermediate. So just a little differentiation there, but both charged higher the first quarter as this happened, actually from the start of, February on through March. And as you can imagine, oil prices drove gas prices much higher in our country. The average for the nation was $4 per gallon by the end of March. Obviously, in our area out here, for those of you that are in the Chicagoland area, we're above $5 per gallon or we were pretty quickly, and we're above that now. But ceasefire headlines started coming through at the end of March, which kind of paused some of the volatility in the market. That's where we started to rebound. And also, it's brought oil prices down, depending on whether you're looking at Brent or WTI, it's in the upper 80s to mid 90s now. Still quite higher than it started the year at, but we're seeing a little bit of reduced pricing there.
So, really, one of the most common questions we're getting in our review meetings lately, or from any types of conversations we're having, is whether or not our economy is headed for any kind of trouble. In short, what the data suggests, or what I sometimes refer to as the plumbing of our economy, it shows that things are cooling and slowing, but definitely not breaking. Inflation's still a little bit above target. That recent pressure mostly comes from the conversation Nick was just having about oil, and kind of just energy in general. We also see that right now the Fed is staying patient. It's still signaled that we're expecting rate cuts this year, but maybe it's going a bit slower than we would have expected. So more to come on that throughout the year. Maybe we see 1 to 2 rate cuts, which could be good for the economy and be helpful in an environment like this. Another really important thing to have been paying attention to over the last couple of years is the job market. I'd say just about every 3 to 6 months over the last maybe 4 years, someone is talking about whether or not we're in a recession. And a really important thing to pay attention to is the job market. So we've seen the job market soften a little bit, but unemployment is still extremely low by historical standards. And this number you see here on the screen, 4.4%, that was actually adjusted even lower since that estimate at the end of quarter 1. So again, this is a very different story than a recession. Some people maybe we sound like a broken record to some of our clients where we say this, but if you put our team on a research project to prove why the economy is doing really great, we could do that. And if you put us in position to tell you why the economy isn't doing so great, we could do that as well. There's usually data to suggest both, but objectively, right down the middle is a sign of a cooling and slowing economy, but nothing that's fundamentally broken. Another important backdrop of our economy and stock market right now has been the evolving tariff landscape. Um, Basically, the legal framework has changed, but for investors, the bigger point is that the overall policy direction has largely stayed the same. And it's still a factor in things that are on the list of things that are moving our markets right now or have the potential to move our markets. What's important to understand about tariffs is that markets have already shown that they can adapt to this kind of policy environment over time. And the key word there or key phrase is over time. And this is something that we saw very clearly last year. While we had a sharp decline as a result of the uncertainty of tariffs, we also had a very sharp comeback in the market after we saw that big downturn. A theme that I'd really like to focus on here is that investors who made really big moves based on tariff headlines probably found themselves reacting at exactly the wrong time. The takeaway here isn't to ignore the policy, but really it's just to avoid overreacting to it. This is probably going to continue to be a changing landscape over the next few years where we see subtle shifts. Volatility might be a reaction to some of this in the stock market or economy. But what's great is that our market has shown that it's resilient even in the face of policy changes like this.
All right, we're going to zoom out quite a ways out here for a minute. One of the best tools we have as financial advisors is perspective. And we like to always put things in perspective, especially after a pretty rough quarter, pretty volatile quarter with a lot of headlines and concerning things going on in the world. Um, but when we take a bigger, wide lens view of things, it really helps out a lot. So just looking at some things, big picture here, if we look back to the S&P 500, which was actually started, I believe, in 1928, they technically, I believe, only had 90 stocks at that time. But if you had invested $100 at that time into what is now the S&P 500 and just reinvested those dividends, never touched that portfolio, your $100 would be worth $1,157,598. Granted, I realize that's almost 100 years of not touching your investments, but it's the power of staying in the market and staying disciplined. So that has equated to a little over a 10% compounded annual return, going back to the start in 1928. And 74% of the years over the last, call it 98 years now, the S&P 500 has produced positive returns. So essentially 3 out of every 4 years is a positive year in the S&P 500 when we're looking at calendar year. And we've survived a lot, everything from the Great Depression to World War II, oil shocks, tech bubble, 9/11, the great financial crisis, global pandemic, more recently the Ukrainian war, this Iran conflict. We could go on and on, 100 years worth of turmoil in the world. And the stock market continues to essentially give us the same result. The details are always different, from conflict to conflict or whatever might be going on in the world, but the end result is always the same. We always recover, we set new highs, and it shows the resiliency of our country and our stock market. When we look at bull markets versus bear markets, the average bull market lasts 4.4 years, and the average cumulative return over those 4 years is a positive 151%. So that's a massive amount of return in a short amount of time. Now, the average bear market lasts much shorter. It's about 11 months, and the cumulative loss on average is 31%. So if we can weather those storms, those bear markets, the volatility, we get rewarded over time with these massive bull markets. So I know all of you that are clients, you hear this from us all the time that we want to build a very disciplined plan and stay the course because we want to harness the power of the stock market. If we put short-term money into the stock market, it may not work for us. And all of you know how we approach that, and we'll review that with our bucket planning philosophy. But it's really stay the course. And the nice thing when we think about putting the first quarter in perspective, typically geopolitical events don't have a long-term negative impact on the stock market. In the short term, a lot of volatility, a lot of concern, a lot of issues, there's no doubt. But long term, usually the market rebounds. As we've seen already, it's rebounding these last 3 weeks. We don't know if that will continue or not, but it's nice to see, a little deviation from the negativity that we saw the first quarter. So we like to bring up this chart as well. It's under that same headline of putting things in perspective. But if we look at the last 25 years, and if you're fully invested in the S&P 500, if you have been, and you put $1,000 in 25 years ago, that would be worth just under $6,000 today. So you've 6x your return by staying disciplined, staying in the market. Now, if you miss just the one best day over the last 25 years, your return would be about 5,300. So it's a pretty big chunk for one day. Now, if you miss the best 5 days, your your balance drops to $3,701. So it almost cuts it in half. If you miss the top 10 days, you're at $2,600. Now, if you miss the best 30 days, and there's over 9,000 days in a 25-year period, you're actually losing a little bit of money. So you could be invested for, 8,950 days, and you miss 30 days, you're actually going to be in the negative. You miss the 40 best days, you're actually down over 30%. So typically your best days happen after your biggest downturns, your biggest down days or bottom in the market. And usually we have a rebound much faster than people think or expect. So it just points us towards diversification, being disciplined, and staying the course when we have this volatility.
Yeah, what Nick is hitting on is a really important perspective of being a long-term investor. It's really easy during these periods of volatility in the market or volatility in the headlines to feel like, the end is near, or, this is the beginning of a new normal. And what history has shown us is that's just not true. A phrase that we like to say here is it's about time in the market rather than timing the market. Um, this is it's so important to understand that the market will forever and always be unpredictable, especially over short periods of time. Over a day, a week, or even a year. I'd consider a year a short period of time as far as our stock market goes. But as your time horizon stretches out, what we're demonstrating here is that your odds of a positive return increase dramatically. You can see at just the 3 year mark of staying invested, even during volatility, it changes your probability to about 88% of having a positive return on the other side of that. Now, to be clear, this data can be altered based on how our portfolio is diversified, the makeup of it, when we plan on tapping into it for income. But in general, the thought here is being a long term investor tends to pay out. The real question isn't necessarily what's the market doing today. The real question is my portfolio positioned for the years and decades ahead? If your measurement of what's going on in the market is daily headlines, it's just the wrong ruler. But this is what turning volatility into an opportunity can look like. Maybe we haven't said it enough, but volatility is super normal. If you kind of flash back to any decade in the stock market, you can take your pick of the litter of, geopolitical issues, issues here at home, provocative presidential administrations, you name it. But since 1980, the market has had an average intra-year pullback of about 14%. In other words, declines are not unusual, they're pretty much expected. A big difference that we have in today's day and age compared to 1980 is just an absolute fire hose of information every single day about the smallest things, the biggest things, and we have a higher than average awareness of what's going on across the world than ever before. And in fact, in most years, the market has had several pullbacks along the way, and yet many of those years still finish positive. So, as an example, this top right quadrant here, about 4 to 5 times in a typical year, there can be pullbacks of about 5% per calendar year. That's a pretty incredible stat. And 2025 was not an exception to this. In fact, in 2025, over 6 times, or 6 times we had pullbacks of over 5%. Yet the S&P still finished last year above 18%. And several other major market indexes finished positive double digits last year as well. So yeah, that's why we say volatility is truly not a sign that something is broken. It's kind of the price of admission for long-term stock market returns. And honestly, Q1's decline was a lot smaller than what history says is normal in a typical year. So volatility never feels good in the moment. We're the first to acknowledge that, but it is certainly a normal part of how our markets behave.
Let's spend a moment talking about bonds because they did exactly what we would hope they would do in the first quarter. So what you're looking at here is going back from March 31st, 2025 to the end of the year, and then also the first quarter. So the aggregate bond index, which is an index of all corporate bonds, was actually pretty much flat. It was down 0.05, so less than half of a tenth of a percent. So very small amount. And so that was flat. We actually had some positive returns from the 2 year note up through the 30-year bond. Not massive returns, but held steady and gave us a little bit of a return across the board there. Another key point is if you look at March 31st, if you look at the 1 month T-bill, it was yielding 4.35%. And you look at the 2 year, 5 year, and 10-year notes, those were all yielding lower than the 1 month T-bill. This is what's called an inverted yield curve. Inverted yield curves are typically a signal of an upcoming recession. And we had an inverted yield curve from 2023, 2024, and then part of 2025. But by the end of the year last year, that switched and things leveled out. So now you're getting compensated for the longer maturity bonds. So the longer you go out, you get a higher yield, and that's how it should work. And that's a signal of an improving economy, one that we don't feel like is leading towards a recession. Now, never say never. Things could come up that could change that. But after these recession fears that have lasted 3, 4 years, we're finally turning the corner in terms of the bond market. So that helps portfolios. Many of you have bond portfolios to help stabilize your overall portfolio to limit the volatility when we have tough quarters in the stock market like we had in the first quarter. So it really gets back to comprehensive financial planning. Today we're talking a lot about investment performance, whether it's stocks, bonds, the economy, all the things that kind of fall into the investment management section of our elevated retirement plan. So the elevated retirement plan is our proprietary process of financial planning, and we're always going to bring it back to this to put things in perspective because your retirement plan is not about one quarter in the stock market. It's about all the things that matter in your life. And the elevated retirement plan addresses all of those things. And so I'll walk you through each of these six key components. First is goals and concerns. This is what drives your plan. We all have different goals, we have different concerns. This is what dictates how we build your financial plan and how we monitor it and modify it over time. That's really going to dictate what we're going to do in these other areas. And then income planning. So this is really the heart and soul of a plan when you're retired or about to retire. Your income stops from your job. Now you need to generate income from your portfolio or from other guaranteed sources, Social Security, maybe you have a pension, maybe you have something like an annuity that will create income for you. But we need to make sure that we supply income for you that meets you at the standard of living that you're comfortable with, and hopefully above and beyond that. And we want to make sure this income never runs out. And by the way, we want to make it as tax efficient as possible. And then we have investment management. We're talking a lot about that today. Unfortunately, many financial planners and financial advisors out there strictly focus on investment management. They don't look at all the other areas of your financial plan. As you know, we look at everything. The investments are a key component, and we need to do that right. We want things to be low cost, diversified, and we want to bucket your money, which Tim will talk about in a second. And then tax management. This is an often overlooked area of a financial plan. We know that we can create substantial value and extra spending dollars in your plan by proactively planning your taxes year after year, looking for different opportunities, looking at ways to save, whether it's on Roth conversions or it's tax loss harvesting, you name it. Our team is always proactively trying to find tax dollars that we can keep in your plan rather than going to Uncle Sam. And then healthcare and insurance, often overlooked and underestimated kind of the impact on a plan, those costs that can arrive or can arise during retirement. And so we dive into these blind spots. We try to protect against all these risks and make sure that you have these things proactively covered rather than reactively just taken on as they come. Whether it's, facing Medicare and different Medicare costs or IRMA when we're thinking about the taxes on Medicare, or just unexpected health events in your life. We want to approach those proactively well in advance rather than being surprised by them or blindsided by them later on in life. And then legacy planning. This is where you want all of your money to go when you pass. We also will talk about, what is your living legacy? While you're alive, what do you want to do? Help out family, friends, your favorite charities, your local church, whatever it might be. But then when you finally pass, we want to make sure that's as smooth as possible and all of your wishes are carried out the way you want them to be. And coordinating all of these things is the key here. These things are always going to change. They all impact each other in different ways. One income planning decision could have massive impacts on your investment management and your taxes. A certain legacy decision could have massive impacts on your tax plan and on your investment portfolio. These things are all very interconnected. And the key is coordinating these things, not just one time, setting it and forgetting it, but laying the foundation and then monitoring it and modifying it as time goes on.
The elevated retirement plan is where we really seek to make planning very personal. And an important extension of that is our bucket planning approach to the investment management. Now, understand that every part of the elevated retirement plan is interwoven through every other part, and the bucket plan is no exception. This is truly a cover page to a very complex story. But the bucket plan is specifically designed to give every dollar in your plan a purpose and a time horizon. And it's something that has helped our clients over time really tune out market noise and have a plan that is honestly fortified from all the things going on in the market rather than being put in a position to be reactive to it. So, just quickly, the now, soon, and later bucket are the three buckets that comprise our bucket plan. In the now bucket is where we want enough money parked there or coming in to meet your obligations over the next 12 months. And you see the terms safe and liquid here. The goal is for all the spending that we need over the next 12 months, either our normal day-to-day or bigger planned expenses, we want access to it at a moment's notice, and we really want it to be 100% insulated from whatever's going on in the stock market. Next is our soon bucket. The soon bucket is the bucket designed to help us get through the next 2 to 10 years. This is the bucket that is so important to weather market volatility. This is where we build out all your potential needs over the next 2 to 10 years. Again, your normal day-to-day spending, but also the extraordinary things that might come in that horizon too. Whether it's, gifting to your family or a new home or big trips, you name it. And the goal here is to protect on the downside. You see the terms conservative and income oriented. Capital preservation is really the name of the game. Now, we understand that with a 10-year time horizon, growth needs to be a part of that. A soon bucket looks different for everybody depending on your goals and concerns and all those other areas of your elevated retirement plan. We take it through that lens and that filter to get down to how much money you need here and exactly the way it should be invested to help you meet your goals. If we have our now and soon bucket properly allocated, what it's done is given us a 5 to 10 year time horizon to let all the rest of our money sit in the later bucket and grow. Long-term growth means something different to every investor, and that's something that you need to figure out for yourself or along with the help of an advisor like us. But having your money be able to grow while we have money for the next 5 to 10 years is a superpower, especially in markets like this. Those normal drops that we see intra-year of 4 to 5, sometimes even 6 or 10%, it helps us tune those out and not make emotional decisions. Well, of course, we'll see our long-term growth bucket be affected by that, but it's nothing to run to the bank to and say, we need to change our entire plan around. What this does is it creates a really good separation between your daily living needs and stock market volatility. It's extremely valuable in quarters like this. When the market gets noisy, a retiree with a proper bucket plan shouldn't have to panic. You all have earned the right to have a retirement and a life that's not dictated by noise in the stock market. So what does this all mean for your portfolio and just kind of in general when thinking about a financial plan? First and foremost, stay the course. A quarter like this is well within normal market behavior. Second, diversification is working. We saw that through the market rotation of people selling growth stocks and buying value, the discrepancy between energy and technology, and also between domestic stocks and international exposure. All of those things have helped tremendously, not just this quarter, but also last year, 2025. Third, and very importantly, we want to avoid emotional decisions. Damage in a portfolio usually doesn't come from volatility itself, but really just reacting to it poorly, or maybe not having a plan that's guiding our decisions. The right question isn't, should I change my portfolio because of the headlines? It's more so, have my goals, my timeline, or my life changed? If you have a really good plan in place already, those are the things that should be dictating whether or not we make broad sweeping changes across your portfolio. If your life has changed, we adjust the plan. If it hasn't, the plan is likely still doing exactly what it was built to do. And finally, fixed income and a landscape is changing there. That's important when we're talking about things like recessions, income in a portfolio, stability, diversification. And lastly, watching some of these future catalysts this year and how the market reacts are going to be some important barometers throughout the rest of 2026.
So what to watch for this second quarter and throughout the rest of the year? So we will have a new Fed chair transitioning. I believe it's late May. And actually this morning, it may still be going on. Trump's nominee, Kevin Warsh, is testifying in front of the banking committee. So one thing I did hear out of that testimony early today was that he wants to be focused on keeping the Fed separate and independent. That's been in the news headlines a lot for the last year and a half. He doesn't want to take marching orders from Trump or any other president. He wants the Fed to remain independent, which I think is key to our economic health. This year is a midterm election cycle, so we have midterms coming up later in the year. We typically see a lot of volatility 6 to 9 months out. There's a lot of different fiscal policy debates. There can be things about the debt ceiling, spending, you name it. Um, look for these ads. You're probably already seeing them on TV and everywhere else. Seems like it's never ending, but it is a midterm year, so we typically will see volatility spike. Obviously, the Iran conflict and oil are big headlines that we need to watch. Ceasefire talks are ongoing. A resolution here would be great for the market in two ways. One, would lower oil prices, which will reduce inflation. And then also, it will probably be an equity catalyst where we'd see the stock market kind of take off, especially stocks that maybe were hurt by higher oil prices. And we have earnings season. It's already begun here in April, and we'll see how different corporations have absorbed the increased cost of oil and gas, and whether they absorbed it or they passed it on to consumers. It's also going to be tough for a lot of these companies to beat their earnings from a year ago because they had such strong earnings, in 2025. Labor market, we want to watch. February had unexpected losses. March had a good rebound. So we'll see where that goes the rest of the year. At 4.3, 4.4% employment, that's considered full employment. I'm sorry, 4.4% unemployment is considered full employment, which is typically a good sign for the economy. One thing we haven't talked at all about today is AI and AI's influence on the job market and the economy. We could see more job losses due to AI, so it'll be, interesting to watch and see how that plays out. So it's kind of an interesting one where you have on one side, you have AI making people more efficient and companies probably saving money. On the other side, it can hurt the economy where people are losing jobs. And the consumer makes up about two-thirds of our GDP each year. So if we have less consumer spending, that can trickle down into the stock market as well, with earnings and whatnot from different corporations. And the inflation. So mentioned that briefly, inflation trajectory, oil, if it stays high for a considerable amount of time, it will cause a decent amount of inflation. If that comes down and stabilizes, that could be a sign that the Fed may continue rate cuts later in the year. So all these things we're going to keep an eye on and see where it goes. Those of you that have been with us years, you know that we are not reactive to short-term movements in the market. We take that disciplined approach of bucketing your money, diversification, and really we're looking for opportunity. That's the biggest thing I can kind of emphasize here is that when you build a financial plan the right way, you bucket your money, you take the elevated retirement plan approach and look under the hood in all different areas, you put yourself in the driver's seat to really be proactive when the market gives us opportunity. And typically there's opportunity when the market's down, whether to be proactive with different tax strategies or proactive with putting money to work when the market's low. I mean, it's really a great perspective when you have the control to be proactive rather than reactive and you're back on your skis when the market's down and volatile. So if you're on this call and you don't have a bucket plan or an elevated retirement plan, please let us know. We want to help build that for you, and we have a way that you can speak with us. But the people that with or typically tolerate volatility more are those that have a plan and a disciplined approach. And so if you're missing anything there, or if you're a current client that needs any more info on that, and need an extra meeting, let us know. Key takeaways here. First quarter pullback is normal. It's not alarming in a historical context. Geopolitical events rarely derail long-term markets. Diversification works. So even though the S&P 500 was down, if you had diversification, your portfolio did better than the market with energy, value, international, you name it. As Tim touched on, time in the market, not timing the market, is what builds wealth. And we want to harness the power of the market to work for you and your financial plan. Even if you're retired, you might have 20 or 30 years where you can harness the power of the market with a portion of your retirement dollars that you don't need today or over the next few years. Like we mentioned, our planning approach between the elevated retirement plan and the bucket plan will keep you on track. All right, so next steps, schedule a review. So if you're clients of ours, we probably have your next review meeting already on the calendar. If not, and you want something sooner, let us know. And if you are not currently a client, you could sign up for a strategy session where we'll spend 30 minutes diving into all your questions, either over the phone or a Zoom meeting to really just answer any questions you have about the markets, your overall financial plan, our services, you name it. We're happy to just be a sounding board for you. But right now, we want to open it up to the question answer section. So please type your questions into the Q&A section. We have until the top of the hour here, so we have about 18, 20 minutes left. So please type them in. Looks like we have one right now that says, what impact will our exploding national debt have on the market over the next 5 years? Tim, you want to jump onto that one?
And also, just real quick, guys, if you're not seeing where the Q&A is, if you're on a laptop or computer, generally it'd be around the bottom area. You should see a button that says Q&A. If you're on a mobile device like an iPad or an iPhone, you might have to swipe left or right to get to the screen where you can click on the Q&A button. And once in there, you can submit questions for us and our team to see. All right. Thanks for the question on what the impact of our exploding national debt will have on the market over the next 5 years. Yeah, I mean, the problem is really on both sides of the aisle. Over the last 20 years or so, we have an absolutely obvious spending problem. Something we harp on a lot is probably more directly we'll see an impact on tax legislation. Obviously, tax legislation has a potential to impact our economy and our market from a spending, velocity of money perspective, capital markets, et cetera. It really does remain to be seen. This has been a topic of discussion every year for the last 5 years or so by major economists, institutional investors, and something that a lot of people are anticipating. In short, if we can all agree that there's a problem, hopefully our legislators are equally as aware of it. And luckily, all of our legislators are also invested in the market. And my hope is that, they have a vested interest in figuring this out and getting back to a homeostasis. But you could certainly plead a case for why the market has to implode or why we could keep an ignorance is bliss perspective against that exploding national debt as time continues on, which is what our country has proven to do over the last few years, right? Spending has been through the roof, yet our stock market continues to paint all-time highs. 2023, 2024, and 2025, double-digit returns in almost every major market index. So it's a really good question, something that we always have on our radar, but unfortunately, there's just no perfect answer to it. Nick, do you have anything to add?
Yeah, I think many of you are probably aware of the One Big Beautiful Bill that was passed last summer that extended the Tax Cut and Jobs Act that was put into place back in 2017 that made the current tax legislation permanent and tax brackets and codes and all of that stuff permanent. Now we know that nothing is permanent in Washington. New administration in a few years could go in and completely change the entire tax code and tax brackets and everything under that heading. So we feel like taxes likely have to go higher at some point in the future.
Mm-hmm.
So we're very proactive with the tax planning we do for all of our clients. What can we do today and over the next few years to put ourselves in a better position to tackle rising tax rates in the future? So, it takes some different kind of assumptions that we use there. But what can we do today to impact it? Paying tax at a known rate today rather than rolling the dice at potentially much higher rates in the future could put you behind the eight ball if you ignore it. So we're very proactive in that side. And even if tax rates never ever go higher in the future, tax planning strategies are still very valuable. And I think the odds are they will go higher, things will change. Hopefully not for, at least 4 to 6 years, maybe as many as 8, but we would expect some changes down the line at some point.
Great question. All right. Still got about 14 minutes left. So if anybody has any other questions, feel free to roll them in.
If not, Tim is just going to start singing.
Yeah, I have an absolutely beautiful singing voice. Said nobody ever. If I could get my son on here to sing some Pokemon songs, it'd probably be a
Yeah.
lot more entertaining.
What does the fox say? That's a really entertaining one. Yeah. feel free. You can ask any questions, not just about this market update, but anything relating to financial planning. That was a great tax question. Um, Anything else that comes to mind? If not, not seeing anything else coming in. All right.
Still hang out just in case someone gets inspired. Wait a few more minutes.
Yep. And like we mentioned at the beginning, we will send out a recording of this for all of you that if you want to watch it again or share it with people that could benefit from it, please do. We'll also have an opportunity for you to sign up for a strategy session. Or like I mentioned, for those of you that are current clients, if you don't have your review meeting on the calendar, we can get that out to you.
Mm-hmm.
Um, we do have a new client experience employee that just started today. Her name is Shar. So many of you will get to meet her next time you're in the office. She'll also be calling soon to start booking more appointments. So we're excited to have her on the team.
Oh, we got another question coming in here. So the question is, can you discuss tax loss harvesting? Don't think I have ever heard you mention that in the past. Nick, you want to take
Yeah,
that one?
sure. Yeah, tax loss harvesting would apply to any type of investment that you have outside of an IRA or retirement account. So, simply put, let's say you have an investment account that's in your individual name, maybe a joint account, maybe it's in the name of your trust. And let's just say you have a handful of stocks in there, 15, 20 different stocks. Some of them are up, some of them are down from the time you bought them. Tax loss harvesting is where you go in. Typically, this is considered something, that people recommend doing at the end of the year to see where if you have any gains you've taken throughout the year, do you have any losses that you could take to offset any gains? Or maybe it could just be cleaning out maybe some duds in the portfolio that are losses. You take the loss. So as an example, let's say you bought a stock for $20,000 and in December it's trading at $15,000. You sell it for 15, you take a loss of $5,000 that you can offset any gains you have for that tax year. So if you had a gain of 10,000, subtract the 5,000 out. Now you have a long-term cap or you have a capital gain of $5,000 that you'll pay tax on. If you don't have any gains to offset that loss, you can carry it forward for the next year. So the IRS allows you to take a $3,000 loss if you have no gains to offset it, and the difference will roll forward into future years that you can offset future gains. So in that scenario, if you didn't have any gains, you could take your $3,000 loss on your tax return, carry forward the other 2,000 and use that later. That can be a really proactive approach in a lot of different ways. We have some portfolios that do daily tax loss harvesting
Mm-hmm.
that are um, pretty powerful with even in positive years. Like for example, we've reviewed a few of these with clients recently that in 2025, their portfolio in this program was up 13 to 15%, but they locked in losses of 10% of the account value. So if someone had $1 million portfolio, they locked in 100,000 of losses while the account actually grew by 13, 14%. It's a little counterintuitive, but it's a really powerful way to put you in the driver's seat for just harnessing taxes while
Mm-hmm.
at the same time growing your money, which a
And
lot of
also,
people. Oh, go
sorry to
ahead, Nick.
interrupt, Nick, but like just to the theme of today's webinar and quarterly market update, like anytime we're in volatile market cycles, a really important thing to be considering is how can we take advantage of it. Usually, if you have a really great plan in place, it allows the space to think about decisions like that. And there's several ways you can take advantage of volatility in the market, and tax loss harvesting is one of them. And what we love about it is that, like Nick described, it tackles not just really great investment management, but also tax efficiency for the rest of the time that you're invested in the market.
Yeah, but you cannot take advantage of that if you have a retirement account, in
Correct.
those types of accounts, only in your taxable non-retirement accounts. Yep, great question. Any others? Please type those in.
Buzzer beaters.
I'll take this opportunity to mention a couple fun events we have coming up over the next few months. We have a family fun fest, I think is what we're calling it. That is Sunday, I'm just going off of memory here. Correct me if I'm wrong, Tim, June 7th,
Yes, that is correct.
where you're all invited. Bring family, friends, anyone you'd like. We're going to have a live band, food, drinks, food trucks, a lot of activities, all ages, kids, probably a couple bouncy houses. I think we did this a few years ago for the young kids. There's a little playground there at the park. It's in Aurora. So be on the lookout for that. I think the save the date just went out today or yesterday. And then we last summer we did our um, first ever charity golf outing that also included pickleball and a few other activities. We're going to be doing that again this year, and it will likely be in the fall. Um, so we have a tentative date right now for late September. That could possibly change, but be on the lookout for that. Great opportunity to raise money for a great cause, but also get together and have a lot of fun.
Yeah.
And hopefully it won't be 98 degrees with 100% humidity like it was last summer.
Also, we have tried to be in good practice of putting on some kind of informational webinar every month. We're trying to get into practice of having a quarterly market update every quarter indefinitely. But in the meantime, we have other really fun and exciting topics coming up. Things about planning for adult children, looping your kids into what making smart planning decisions means, things about charity and philanthropy built into your plan, gifting, tax planning. So lots of really cool webinar topics for the rest of the year to tune into. We typically send out updates on those via email. If you ever want to be tuned into what's really locked in and when we have dates coming up, our website is probably the best resource to find those. And it's a great way to meet other members of our team or at least hear them talk. Our team has been really generous in wanting to speak on topics they're passionate about or really enjoy talking to the theme of. So pay attention to those. Great way to meet more of the team and get some great information on other topics.
Yeah, I don't see any other questions, so I think we will end on that note. Thank you all for coming out and attending. Thanks for your great questions, and we'll see all of you soon.
Thank you guys.